Well, thank you very much, George, for that excessively kind introduction. Before I start, where's the guy that called me last night? I was a little short. I was a little short with you. I apologize. Timing is everything in life, as you know. Okay. Thanks for inviting me to address the class. I appreciate it. I'm very happy to see my alma mater embracing value investing as a discipline. When I was here, we didn't hear much in any of the finance courses except about the capital asset pricing model. So congratulations. Rather than giving a set-piece speech here, what I thought I'd do is just deal with some issues. Jeff Feng, who's took this course last year and who's now a Burgundy analyst, assured me that the Q&A in this course is the best part. So I'm just going to give a brief presentation, open it up for questions as soon as I get that out of the way. First of all, I'd like to talk about sort of the different tribes of value investors that there are out there. Burgundy's may be a little different from some of the other people you'll meet. I'm going to discuss the different tribes, how they approach their job, and what they look for, and particularly what their challenges are in this environment. Then I'm going to go through this presentation about who Burgundy is and how we invest, and then I'll open it up to Q&A. Now, Warren Buffett has said that personality and character are the keys to becoming a successful value investor. I think each of us, once we have done our apprenticeship and get the opportunity to invest in a reasonably unconstrained manner, we tend to embrace the kind of value investing that suits our personalities and tastes. It's a big tent, value investing. There are several tribes within it. The original inhabitants were Ben Graham and his followers. They, of course, use book value, dividend yield, and latent values as the basis of their approach. They, to a lesser extent, use PEs, although there are some very fine Graham-type shops that use PEs very extensively. I think you can generally say that Graham people look for value, look for their margin of safety in the balance sheet. Buffett disciples are a more recent contingent, I'd say the last 20 to 25 years, and they look for a margin of safety in the business. To some extent, you might say they look at the income statement more. Barriers to entry, persistent margins, return on invested capital, free cash flow. Both of these groups are confronting challenges in the environment of this decade. First of all, let's look at the challenges facing Graham-type investors. Book value has been rendered less and less useful, as in the analysis of many businesses. Stock buybacks and the way they're accounted for, massive write-downs whenever the CEO changes, huge intangible asset positions. These are all things that militate against using book value for large areas of industry, really. It used to be that book value reflected the gradual accretion of historical cost earnings net of dividends around a core of issued stock, and that's simply not the case anymore. Price to earnings is even more challenged. People increasingly are moving up the income statement to find comparability because the lower down you get, the more chaos there is. Pro forma net earnings, EBIT, EBITDA, EBITDA. And I'm here to tell you that it's going to get worse before it gets better, because in my 3 years on the Accounting Standards Board, what I saw was that the accountants are more and more interested in moving to a full fair value accounting standard or basis. It started with hedge accounting, and it's gradually infiltrating the books. What that is going to mean is a great deal more volatility in both GAAP earnings and the resulting book values. This is all in addition to the traditional problems that PEs had with volatile or cyclical businesses, where you have to buy them when there's no PE and sell them when there's a low PE. Now, latent assets, which is the other area where Graham investors excel, I think that's a basis. That's a standard for any value investor. That's something you can learn from management if there are latent assets on the balance sheet. And that's a reliable and intelligent way to approach things, and should be the basis of most interviews with management. The other thing that you have going for you is dividend yield. Now, the older I get, the better I like dividends versus stock buybacks. I was strongly in the stock buyback camp 15 years ago, but I've changed my ways. I don't know if any of you saw the Business Week of January 23rd. There's an article about stock buybacks in which they showed that despite hundreds of billions of dollars of stock buybacks in the USA, share issuance continues to give higher share counts for American companies. So the whole thing is sort of a fraud. It's optioned up management, pumping stock out into the market and then buying it back to preserve for shareholders the illusion that they're not being diluted. So dividends, you know, in a financial environment where nothing really is sacred to management anymore, where they are willing to go to great lengths and sometimes any lengths to present the kind of financial picture they want you to see and believe. Dividends are a rare pocket of integrity because you can't fake a cash distribution. Managements are very uncomfortable with dividends. If you look at it, they only give dividend increases when they feel that they can support the increase. They don't cut or pass them unless they absolutely have to. So to me, that makes them pretty attractive. Now, there's also pitfalls for Buffettites of the sort of buy and hold a great company variety, which I guess is my tribe. The underlying assumption is that the business in the future is going to enjoy most or all of the competitive advantages that it enjoys in the present and in the past. But if you read the Berkshire Hathaway annual meeting minutes for the last few years, Buffett and Munger are both saying that the barriers, the moats as they call them, barriers to entry, are getting narrower and narrower, harder and harder to defend. So, and if you look at what Buffett's been doing lately, he's buying public utilities, expecting the repeal of the Public Utilities Holding Company Act, bricks, carpets, a lot of things that people who say they're Buffettites wouldn't touch. So he's going where the value is. He's not buying Coca-Cola. High free cash flow companies that Buffettites invest in are always also most at risk from what I would call legal management misbehavior, mainly excessive options issuance. Almost any option issued on a large, mature, free cash flow generating entity is an unfair thing, in my opinion. There are a couple of other groups of investors that sort of claim residence in the value investing tent. The first group I would refer to as bears, and you're going to meet some of these, and maybe you're even one. There's nothing wrong with that. Bears always have cash, usually a lot of it, 30, 40, 50, 60% of their portfolios in cash. They have an extreme interest in top-down systemic catastrophes. They're always buying barbed wire and canned food. Market declines for these folks tend to be harbingers of doom that prevent them from getting fully invested rather than opportunities. They have a fascination with gold. They run huge opportunity costs, but they're sort of compensated for that by doing really well during severe market breaks, like '87. Almost never losing money, which, as we all know, is one of the keys to the whole thing. And finally, they get a lot of the best lines in the business. I don't know if any of you read Grant's Interest Rate Observer, people of that ilk. They're among the best writers in the business. The last group I can identify as sort of what I call dogmatic Buffettites. They're people who never stray far from what Warren Buffett is on the public record as having done. They tend to obsessively learn more and more and more about certain companies that either Warren Buffett owns or that they think he would own if only he knew about them or could invest in them. Now, all of these approaches can work, and in a given market environment, there'll usually be pretty much one or more of these categories of investors represented right at the top of our profession. But there's also another side to the coin in certain kinds of markets, like we saw in 2000, and like we're seeing today. Both Grahamites and Buffettites can be frustrated by lack of opportunities in their chosen areas. Bears can be frustrated by the rarity of catastrophes. Dogmatic Buffettites can get painted into the corner of highly valued consumer names or challenged businesses like newspapers. And we're all in trouble when the market's generally overvalued, which has not been an unusual circumstance in the last 20 years. So each of you probably feels drawn to one of these types of investing, and you'll probably have to undergo some training and experiential learning to figure out what suits you best. And someday I hope you get a chance to apply the craft without too many restrictions. It's a great thing to do, either for yourself or for clients. It's the real fun of the business. So with that, I'm going to turn to this presentation about Burgundy. The firm was founded in 1991. I joined it, as George said, in 1995. We're now a little over $8 billion in assets under management. We're pretty proud of our client retention record. That actually understates it. I think it would be more like 95%, which is highly unusual in this business. And you'll see that as we go through this, that part of it is because we scare the hell out of just about everybody who shouldn't be a Burgundy investor before they sign up. So that tends to mean the people that do sign up know what they're doing. We're about 50% high net worth families, which is a great business. It's about as good as it gets in asset management. 50% institutions, but again, see my previous comment. For various reasons, we scare the hell out of the ones that shouldn't join us. 80% of the assets are from Canadian-based investors and 20% from U.S.-based investors. We found we could not sell our our U.S. small cap fund to Canadian investors despite its excellent record, so we had to sell it to U.S. investors who bought it with great interest. Company is 100% employee owned. Almost half of our employees have stock in various amounts. We do our own research and analysis. We don't rely on the other side of the street really for anything. That's not true, actually. We use them sort of as a dating service. They bring in managements for us to see. And finally, and most importantly, we invest our personal assets alongside our clients. 100% of my investable float is invested in Burgundy pooled funds with my clients. These are the guiding principles. They're to some extent self-explanatory. We do not think preservation and growth of capital is a mutually exclusive goal, unlike bears. We work by attempting to determine a company's intrinsic value by using a variety of different methods, and invest only when a significant discount to that value exists. What we call that discount is our margin of safety. So that's the way we do it. We're totally bottom-up. We do not focus on macroeconomic events. If we look at economic events, we look at them through the eyes of our companies. So rather than sitting back and trying to figure out what effect rising interest rates might have on the economy and then on the market and then on our portfolio, we go out to the companies in the portfolio and ask them what effect rising interest rates will have on their business. That's the best measure for us. The second point is a little overstated, I would say. The fact of the matter is, one of the most difficult things you can do is to assess management and businesses from outside a company. And to say that you're not relying at all on conjecture or intuition is not true. We try to minimize the amounts which we rely on conjecture or intuition. Burgundy owns concentrated portfolios. In large cap portfolios, we'd have about 20 to 25 names. In all cap, probably 35, and in small cap, maybe as many as 40. We would have no portfolios with more than 40 names in them. We're trying to find companies that we can own for the long term. Turnover in the portfolios tends to run about 20 to 25%. That varies, of course, according to what the market's doing. In small cap portfolios, if you have a big run, you're probably going to see 40 or 50% turnover. But over time, it's tended to be a 4 to 5 year hold period for our investments. Seeking stability and long-term growth and having low turnover portfolios means that we don't react quickly when there's some gigantic trend that comes out of the blue and blows the market to pieces. We'll talk about that a little later. And finally, I think an important factor is we don't measure ourselves too obsessively against relative benchmarks. We like to use long-term absolute positive returns. Companies we look at, their business characteristics, we don't like cyclicality. That's what economic resilience means. That tends to mean we are close to the consumer. Tends to mean we don't have a lot to do in cyclical commodity-related businesses. Any company that publishes an annual report says it's an industry leader, but I think you actually, you know it when you see it. Limited competition and barriers to entry is the hallmark of what we do. That's what it's all about. As I mentioned before, that's getting harder. We've seen amazing things happen in a lot of different industries over the last 20 years. I was just at a big media conference down in Florida last week, and it's pretty remarkable what's gone on in media. You think about Google and Yahoo, and you think about satellite radio and all the rest of this stuff. It's quite remarkable. So a lot of companies that would have been in unchallengeable positions 10 years ago are now hurting, and hurting badly sometimes. Managerial characteristics, I'll gloss over this a bit because frankly it's pretty rare to find. I'm getting pretty cynical in my old age. Capable managements are reasonably easy to find. Most of them are mainly interested in getting wealthy while they can, Since CEOs are replaced every 3 or 4 years now on average, they sort of have to use slash and burn agriculture in order to maximize their take. And of course, the people they can take it from is us as shareholders. There's an excellent capital allocation record. Those do exist. And I would say we quite often look for managements who have a lot of stock and who have been in place for a long time. Insider ownership means they have stock. They participate exactly the same way in the company as I do. It does not mean they have options. Good corporate governance has unfortunately turned into a total nightmare for a lot of companies with Sarbanes-Oxley. We tried to tell companies throughout the 80s and 90s that they had to clean up their act or else somebody was going to do it for them, and nobody wanted Sarbanes-Oxley. It's a horrible imposition on everybody, including management. Financial characteristics, these are all pretty self-evident. You know what we're looking for. You've all read Buffett, presumably, and know what his portfolio looks like, and that's what we're looking for. Excellent companies, though, are not necessarily excellent investments. We're looking for intrinsic value of a company, which we've used a lot of different things. We've used DCFs, but DCFs are pretty useless. We've used residual income models. We use internal rate of return models quite a bit. We use, of course, private market values to cross-reference. And we use hard asset values where we can, but that's been a tough place to be for a long time. I always like the Warren Buffett's statement that value and growth are joined at the hip. We don't believe in paying much for growth. We pay nothing if possible. And occasionally you do get those shots. So we're looking for companies that can increase their intrinsic value over time. And we invest in a company when the stock price is 30% below the intrinsic value estimate. 3 occasions when we sell. First of all, the stock's blown through the margin of safety, through the intrinsic value, and there's no margin of safety. Secondly, there's a nice way of saying when we get it wrong, because obviously if we found a company with all those wonderful characteristics, there shouldn't be a permanent deterioration in its fundamentals. But everybody gets it wrong sometimes. You also have the possibility that the company does something you just don't understand. It makes some acquisition where they say pay a ridiculous price or in an unrelated business or whatever. The last one is if we've got one position bumping along close to intrinsic value and another one in the what we call the dream team, the companies we follow closely that looks like it's going to have a big upside, then we can do a switch. And I mentioned about turnover before. When we founded our company, we wanted to make it a global company. As you know, the government can always pass one law, and that's the law of unintended consequences. So when they stuck the foreign property rule in 1972, restricting Canadian investors to only invest 10% of pension funds outside Canada, they essentially eliminated the Canadian investors' incentive to learn to invest outside his own country. And that's why we have not very many people who have integrated global approaches, and so many large Canadian money managers hire offshore managers, Americans or Brits, to manage for them. We started with Canada and the United States. We launched our Japan fund in the teeth of a screaming gale in February of '98. We launched our Europe fund in March of 2000. We've rounded out the Far East and Australia over the last year. And the philosophy works everywhere. Performance has been pretty decent. You can see it's prone to leads and lags with the TSE. This is the Canadian equity and the U.S. small cap. The small cap is the one that we sold mostly, about 90%, to American investors. European equities, Japanese equities. This is all out the tailpipe, of course. Nobody can buy it, and it's completely useless for anybody on a going forward basis, but we've been doing okay. The investment team, this is always a work in progress. We're up to, I didn't even count them, I think it's around 17 or 18 now. The core of Burgundy is the people that have PM after their name. Those are the people that have been together for a long time. The way we're structured is to give them maximum responsibility and authority. I do not interfere in anybody else's portfolio management decisions in Europe or Japan or anywhere else. We've worked together a long time, and we know we sing from the same songbook, so I just don't have to worry about these folks. If I had to veto somebody's decision, we wouldn't be having a veto conversation. We'd be having an exit conversation. And you can see we've got significant analyst coverage now in various areas. What do we look for in analysts? Doubt if you're interested in this. You can see strong values, trust, work ethic, interest in value investing. In order to be a really good value investor, though, you have to not really care at all what anybody thinks about your opinions. Preferably combining that with humility and intellectual curiosity. So we want a paragon, essentially. We occasionally find them. I think Jeff Fang is a pretty good example. He's a very fine young guy who joined us from this class last year. And a little tale from Ben Graham. Now, the second part, I guess, part two of this handout that I was given that I was supposed to cover, I think we've covered a number of those other things. But I handed out returns for Burgundy. This is the sheet that we hand out to consultants and clients and potential clients every month. And you will notice that the recent returns suck. Then you will also notice, I hope, that as you go to the right of the sheet, the returns suck less and less until they don't suck at all. And then finally, on the extreme right, they're actually damn good. The second page, I think, shows you what we're all about. Those are the returns by year. Look at 1999. We don't pay attention to the index at all. We had no tech in 1999. We have no energy today. We go where the value is, and we stay away from where the value isn't. We define risk as risk of absolute capital loss, not as volatility, not as risk against a benchmark. This is an interesting situation for Burgundy because we were a lot smaller in 1999-2000. What a lot of managers come up against is when you get these are good businesses, right? These are, money management's one of the best legal businesses you can think of. You just don't get margins like this somewhere else. So what most people do is when they get to a certain size, they start playing defense. They start hedging their bets against the index, expecting, doing anything. Just they want to be good enough to excel, but not bad enough to lose the client. We're not going to do that. So it's interesting times for us, the toughest year we've had since 1999. You can see from this what we're all about. There's no value in those areas. But there's some fairly fundamental differences, I would concede, between the current market, the oil market, and the tech bubble of 99, 2000. People were investing in vapor in 99, 2000. I mean, there was nothing there. Whereas in the oil markets, in the energy markets, we have real companies making real cash flow and real profits. So to that extent, it's somewhat different. But it is, when all said and done, a commodity. Its price will fall to its marginal cost of production. Costs will rise until that happens. So it'll all end in tears, I expect. I guess it's supposed to run through a couple of examples, I guess, of decisions we've made. I mean, an interesting one might be from March of 2000, which was the peak of the tech bubble. Just about everything else in the market was being given away. I mean, you can see that in 2000, 2001, 2002, our portfolios did spectacularly well. We probably could have gone to the beach in March of 2000, and we would have outperformed for 3 years regardless. One stock that got spectacularly cheap at that point was Cameco, the world's largest uranium company. We had a mining analyst in. I'm not exactly sure why. I think it was because I used to go drinking with the guy back in the 80s before I quit drinking. And he came in and he was going through, you know, the aluminum, blah, 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 and copper, blah, 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 and all this stuff. And then he turned the page and it was Cameco, and it was just absolutely striking to me. You had a situation where you had the low-cost producer of a commodity, which is the only kind of commodity producer you should consider buying, I think. You had a perfectly predictable demand schedule based on a flat line going into the future forever from a whole bunch of nuclear power stations. You had this massive supply bulge from the 1980s when the superpowers started to run down their nuclear stockpiles. And you had new production occurring at about 40% of the rate of annual consumption. So at some point, the stockpile was going to be run down, the demand was going to be steady, and you were going to see a pinch point like crazy in that particular commodity. This was not rocket science. But the guy was saying, you know, it's been a pig for years and you don't want to look at it and all this kind of stuff. It was the low-cost producer of uranium selling at half book value. We bought it at $7. We sold it at $42 early last year. The stock went to $90. So that's kind of one of the reasons why our recent performance has been difficult. In my opinion, we made the smart 600%, and the other 100%, that's the momentum guys. I think they're usually late and usually end up, you know, drinking the Kool-Aid. So that was an example of a happy ending, I would say. Another example I would give to maybe illustrate how treacherous the current environment is would be Marsh McLennan. This was a really outstanding company for years and years and years. Marsh McLennan, MMC in New York. Insurance brokerage, Putnam, the investment counselor. Mercer's the actuarial consultant. Great record, year after year after year. Tremendous growth in earnings and in dividends, and you know, low capital deployment, everything you like. High returns on invested capital, free cash flow. And then Putnam got into this market timing problem a couple of years ago. You may recall. They covered themselves with disgrace, and the whole thing had to be cleaned up. And they brought in a new guy, and the stock got pummeled. Came down from 62 to 40 or something. And so I looked at what they'd done. They brought in this new guy to clean up the mess at Putnam, and he was doing everything that I would have done in his place. So I figured Putnam's probably just a matter of time. So we bought it. And a few weeks after we bought it, Elliot Spitzer decided to put this company right in its sights. He took a bunch of practices that had been standard industry practice and found a few examples of actual malfeasance in the company and trashed it. That stock went from 42 to 23 in one trade. That's what they do down there. It's nasty. So we bought some more down there, But it's having a tough time recovering. There's going to be $800 million in shareholder lawsuits, settlements. There's going to be all kinds of stuff going on there. So sometimes even when you see good value in the market, I guess I'd say it seems like the immune system's turning on the patient. The Department of Justice, the FDA, Elliott Spitzer, I mean, you name it, exchange authorities. In this environment, it's a real rat trap. It's extremely difficult and very, very challenging to manage. So that concludes my remarks. I'd be happy to take any questions that the group would have. Did I cover off most of the questions, George?
Yes, and the one you didn't cover was could you make the same argument for oil then, or for gold? The one you said in Cameco? I mean, everybody's talking about China and India, and there are not enough mines opened or enough capacity to produce gasoline or whatever, refineries. Can you make the same argument about oil now, or?
Well, thousands are. I guess I would say that I think the India and China arguments have become, well, they're agreeably non-specific, for one thing. And I don't think most people know enough about India and China to make the statements. I was in India in November, went to see a very good cement company there, and they told me that one of their burners was now burning rice husks and peanut shells. And that's going on all over the world. So there are other ways to get BTUs. I'm not suggesting we all switch to rice husks and peanut shells, but the supply-demand relationship will not be as inelastic as people are currently assuming. It wasn't in the 70s, and it won't be today. I guess my argument is that I don't think oil is going to go much higher from here. And since there's not going to be any momentum in the oil price, there's not going to be any momentum in the oil stocks. It's probably not bad for the world if we just sort of wallow around for a couple of years at current levels, because we really should reduce the energy intensity of the economy if we can. But yeah, I don't buy it at current levels, even though most oil companies, I think, are discounting about $45 to $50 oil at current prices. I think probably we'll see 35 before we see 75. Yes, sir.
I'm wondering, you talked a bit about the initial years that you look for companies. Like you mentioned a bit about the characteristics of companies that you look for, but do you have any initial numerical or qualitative screeners when you're trying to find value players?
It varies according to market. For large cap stocks, certainly for mega cap stocks, you generally know what the universe is. As you get into smaller and smaller groupings, there's smaller and smaller capitalization sizes. You rely more and more on screening to kind of pick the nuggets out of the mud. Traditional ones margins are a good place to start. I think our small cap guys extensively screen on operating margins, returns on invested capital, stuff that shouldn't be too surprising. We do the odd interesting thing. Before stock buybacks became so rampant, one really neat thing to do in small caps was to screen on the ratio of retained earnings to issued capital. Since, if you want to think of it notionally, we're interested in companies that don't have to be public. So you'd find these companies that had gone public in 1954 and had never issued a share. And we're, as you probably gathered from my remarks, a little paranoid about dilution. So if you could find a company where 99% of the book value is made up of retained earnings, chances are you had a pretty high quality business. I think we try to be fairly creative about it, but screening isn't an end for us. We're a very qualitatively oriented organization, as you probably gathered. I mean, I think the numbers are at least common denominator. increasingly they're a least common denominator. You see my remarks concerning the accounting principles that we're going to be stuck with. Does that answer your question? Okay. Sir?
What if you own approximately 20% of the large
Mm-hmm.
they run into some trouble last October, squeeze out right before you accumulated that position. I'm just wondering what your long-term view is on the fundamentals.
Well, I'm actually, that's in our small cap fund, and small cap Canadian fund, and I'm in charge of U.S. large caps. So my ability to speak to a lot of our positions is quite limited. I wish that, in fact, we had accumulated all of that position after they made those announcements, but unfortunately, we'd accumulated a good portion of it before they made those announcements. I think our feeling is that they will reinstate their payout sometime this year, probably at something, I think the number we were expecting would be around 50 to 60 cents, which makes it pretty interesting. But I don't really know in any rich detail the fundamentals there. Sir?
Turning to U.S. large cap, particularly the much detailed sectors of airlines and automotive, do you think that these companies will ever represent value? And so what would it take?
No. One of the things that you accumulate over time, often alas at your client's expense, is some experience in things like airline investing, and it's the world's worst business. It's cyclical, it's seasonal, it's perishable, it's unionized, it's you have no control either over your inputs or your output pricing, and hugely capital intensive, usually gigantic financial leverage on top of operating leverage. I mean, it's just about everything that is anathema to us. We were talking about, remember I said the veto idea would equal the exit idea? A really good exit idea would be if somebody came in with an aggressive buy on, Delta or something like that. That would be a pretty short conversation. So, sir.
When you talk about intrinsic value in the calculation, how do you go about to assign the probability to catalyst? That's a very probability process to do output in general.
Again, I wouldn't say we're terribly systematic about that. Sometimes, in large and mega cap investing, catalysts tend to have to come from increasingly from hedge funds and activist investors. The basic story in U.S. large cap land these days is a company that's got a slowly growing top line, huge amounts of excess capital, and they're trying to decide how they split it up to return it to shareholders. In those cases, I think the catalyst comes from within the company, comes from within the fundamentals. You can see Carl Icahn and people like that coming in and taking an active role, pushing square in the case of Wendy's and McDonald's. Some of the hedge funds have been hugely useful in that process because they're very activist. They also they don't buy green bananas. I mean, these guys, they want it all and they want it now. One of the things we did in Japan, we decided that the problems of alignment with management were so great that we actually sought companies where the original entrepreneur or the original entrepreneurial family were still in control. That was the only way that we could ensure ourselves that we had true alignment between our interests and management's, because in Japan, very often, there is zero alignment. They have no interest in outside shareholders. And that worked extremely well for us. That was a guarantee of a certain amount of management rationality in that environment. So there we were actually seeking companies where, now, you might say the possibility of catalysts was extremely remote anyway, and you'd be right, but still, we were sort of, given the absence of a market for corporate control in Japan, we were actually seeking companies where there would be no control issues and where the controlling shareholder and us would sort of we'd eat from the same bowl, so to speak. But I wouldn't say we have any great systematic way of doing that. So I don't have a great answer for you on that one. Sure.
What, how do you decide what your exit point is? Because you're using the example of Cameco, and you got out at 600%, and that's a great return, and you're like, oh, you know, I don't want to be greedy, I want to get out. But fundamentals behind the commodity are still there, and the price has increased even more since then. So I'm just wondering, how do you, like, do you ever kind of, you know, pick yourself in the butt when you're like, you know, I should have seen this, or do you kind of just?
Oh yeah. Oh, hey, that's value investing. You're always early. You're early in, you're early out. I mean, that's the name of the game. I guess you get to the point where, you know, in your judgment, and you know, one of the reasons we don't do a lot of commodity investing is that it's so damn hard. Like the first 10 years of my career, I followed commodity stocks. You know, when George was telling about what I was at Sun Life and then at AMI, I was the commodity guy. That's why Burgundy doesn't own commodities, right? I tried buying them and holding them. That doesn't work. I tried buying them, selling them. That doesn't work. I tried not buying them at all at Burgundy, and that's worked really, really well. So, you know, we'll just stick to what we know. But you know what you're talking about? How high is high? It's the same with oil right now. I could be triumphantly wrong about oil. I mean, I can tell you, if oil starts discounting $80 oil, if we get a bubble situation like we got in 1979, Tony Arrow's probably going to be looking for a new CIO. But, you know, you do what's right. And I don't think that'll be the case. And we can't protect ourselves against bubbles anyway. They just happen. I was naive enough when I started in this business in the 1980s. There was a bubble going on in Japan, and I thought, wow, a real bubble, like the first bubble anybody's probably seen since you know, the 20s. Mutually supporting real estate and stock market and bank loans, you know, banks lending 40% to Tokyo-based construction companies, and it was absolutely insane. And little did I know that that was only the first of many. But, you know, we can't protect ourselves against that. You're right. I guess we got out early. Like I said, I don't think we have anything to reproach ourselves with because nobody else, it seemed to me, was buying it at half book. But what you're talking about is one of the occupational hazards of value investing. I don't know anybody that does it well. And the guy who sells right at the top is probably the most dangerous guy in the room because he thinks he can do it again.
How active are you in actually telling management what to do or taking measures to take out things when they're not doing a good job? Like, are you purely passive at the time or active?
No, we're not passive, but we usually have to leave it up to like we sort of walk around carrying, you know, teacher's sweater, you know, and we're with him kind of thing because they've got the resources to do that kind of stuff. They have huge amounts of people to throw at legal problems, at regulatory issues and stuff like that. We started right off the bat back in 1995. We owned. I inherited the portfolio from a real deep Ben Graham guy, and he had a company called Canadian Marconi. It was trading at $11, had $13 in net cash. And about a month after I joined Burgundy, they cut their dividend. So, you know, we called the management and we said, you know, this is rather peculiar behavior. You could pay a dividend greater than your stock price tomorrow. Why are you cutting your dividend? They said, well, we wanted to send a signal to the market about our prospects. So we said, well, we think we're going to send you a signal. So we got owners and teachers, and we went out and we raised a whole bunch of shit. And Tony Arrow got put along with Howard Beck on the board of directors. And you know what? It wasn't worth it. You just end up in a swamp with some of these companies. It was a company that was controlled by GEC out of Great Britain. So, you know, Tony could whine and plead and do whatever he wanted to, but, you know, that was under good old Lord Weinstock, and he loved cash. So little stashes of cash all over the world. It wasn't worth it. We did a bunch of things with Enterprise Capital back in the old days. Jim Doak's a very good friend of mine. He's no longer there, but they were into this sort of relationship, you know, I don't know what you'd call it, maybe catalyst investing. But it's frustrating, really frustrating. Managements have a lot of tools. There was a question in the back. Yeah, that's a really interesting question. I spent a lot of time in China and quite a bit of time in India, and they're sort of quintessential growth markets right now. I think China, I think, has got to shake out quite a few peculiarities before it's going to be a good place for portfolio investors. India, I think, has a lot going for it, but it's had this monstrous 3-year run, mainly fueled by hedge funds. I mean, these guys are everywhere now. It's amazing. We were as guests of Merrill Lynch's Indian affiliate, and they said they were doing 60% of their business with U.S.-based hedge funds in small-cap Indian stocks. Just unbelievable. So we'll see if the systemic risks in these emerging markets are as great as they were once. If they are, then there will be great value opportunities there. But the big ones, Brazil, Russia, India, China. Of those, I think only India is one that I would consider investing my clients' money in. Sir.
Just sort of on something you talked about before, you talked about looking at management and trying to get some influence management, but how do you go about that, taking a step back, like analyzing management, seeing good management around? Do you talk a lot with them, or is that
We try to. The irony is that the smaller cap the company, the better chance you have to see management. And the larger cap the company, the more carefully staged every appearance, every word that a Fortune 500 chairman and CEO says is choreographed, spun. You see IR, and everybody's paranoid about saying anything. Evaluating management is the most difficult thing we do. And I'd say it's where we make a lot of our mistakes.
So just to sort of follow up, do you use any metrics or anything in terms of this all the qualitative side? If you're using any quantitative metrics that you would go to analyze management?
To analyze management? Unfortunately, what you mainly have to come back to is track record. And as I said, with the incredible turnover in the executive suite recently, more and more of these guys just come in and go for the big deal or something like that. So it's getting to be very challenging. Where you can find somebody who's been in place, like Golden West Financial, sort of a classic case in the United States. This couple, the Sandlers, founded this 35 years ago, and they run this unbelievable operation. It's incredibly profitable, and they've never had a write down. They don't use any derivatives. I mean, it's an amazing financial institution. And they sell one product. That's sort of the one extreme. But if there were more like that, it'd be great. But it's a rarity. Sorry, I'm ignoring this part of the room. Go ahead. Is there anybody over here? Okay, go ahead.
Regarding the risk definition of that came up with the capital loss or another thing or whatever. But then if you change the definition, then how we want to measure actually how we want to benchmark, how we want to measure the performance of the whole system.
Well, the irony is that we actually show up extraordinarily well on all of the consultants' risk measures. Sharp ratio, information ratio, standard deviation, all that stuff. Huge, like off the charts good. What we tell them is we don't care about volatility, but we tend to buy cash flows that are extremely unvolatile. So well protected and not volatile. So it tends to come out in the wash. But it's not a deliberate process. It's not. That's why more quantitatively oriented consultants usually tend to be quite suspicious of us and find it difficult to give us business. That's fine. We don't really like consultants anyway.
What do you do when the stock price falls below the price you purchase it? Do you double down?
Yeah, I have a bad habit of doing that. I would say that's probably on balance been a bad idea. My initial impulse, when something like Marsh Mac, I buy it at 42, all of a sudden it's 23. Well, I'm going to buy some more. If I liked it at 42, I must love it at 23, right? So we average down, we end up with a cost of 33, and it's still underwater. But I think I've had a lot of discussions about this very issue around the table, because there's been a lot of torpedoes out there. It's been a really treacherous market. And I think what we should do first is we should sit down and have a rational discussion about our thesis and whether our thesis for the stock still applies. Because in the case of Marsh Mac, we bought it because Putnam was going to be in a turnaround mode, but the Marsh asset was absolutely solid. There was no questions about that. Well, all of a sudden, the Marsh asset's the one that's on the firing line. So I think probably we should have shown a little more imagination about that. Perennial problem, though. Again, I come from, my remarks about bears were a little bit in good humor because the Sun Life was a bear shop. We were always cash up to our eyeballs, and crash in 1987, we were so busy congratulating ourselves that we didn't buy any stock, and so my initial impulse whenever there's an adverse event is to buy aggressively. But I think that's an area we should, well, as you can tell, we're thinking about it a lot, and I think we'll get a little more deliberate about what we do in those circumstances. Sir?
I understand that you have a small number of equities in a given portfolio, but how would you allocate the funds among these number of equities and how much cash you hold?
Well, again, given my personal background and given the fact that I spent the whole 1980s sort of sitting on 15% cash, I have a personal rule that I limit my cash. I would never have more than 10% cash. I usually try and be fully invested as I possibly can, because in my experience, even though I may be feeling bearish about the market, and all this other outside stuff that can prey upon you, I'm a pretty decent stock picker, and I can make my clients money in most environments. And they're paying me to manage equities, so.
Then among the ones that you invested, would you constantly monitor prices so that you would constantly adjust the weights?
I tend to like to let them run. I like to start off with an equal weighted portfolio and let them run. It's about that scientific. But like Cameco got up to 9% of Canadian equities at one point. A lot of people wouldn't have that. Fairfax was probably 8 or 9% in 1998 as well. Didn't sell enough of that one. Yep.
I'm just wondering, it seems you're very equity oriented, but you have a bond analyst?
Yeah, he just started a year ago in November.
And is that just like treasury bills, or is it distressed debt, or is it?
No, it's credit analyst. Yeah. Yeah, what happened was in the high net worth business, you get clients who come in and they say, well, I want you to manage all my money. And we'd say, we don't manage bonds. And they'd say, well, we want you to manage it anyway. So what happened was we'd have our second senior analyst was given the bond fund. That would be sort of his hobby, and he'd manage the bonds. And one day we woke up and we had $700 million in bonds. And we thought, well, we can't really claim lack of resources at this point. Plus, more and more, our people were walking around in some of these situations saying, well, if the stocks are doing this, why are the bonds doing that? And we needed a guy who could give us that answer. So, and credit analysis dovetails very nicely with what we do. So that's why we did that. It's been a good move for us. I don't think we're ever going to be a big bond shop. We'd like to develop a decent bond business, but the fees for bond management are minuscule. And it's also probably not terribly timely, frankly. 4.5%, 10 years. Not a very attractive asset class, I don't think.
Did you give it a short?
No, I did that once. I took over a portfolio at Sun Life from our U.S. subsidiary, and it turned out he had sent me a 3-week-old valuation. So when I did a mass sale of his entire account because it was crap, I found out that I was actually on the short side of a tremendous number of positions. It was an unforgettable moment for me, actually. It was. So that's the only time I've ever shorted anything. I don't know if you've seen remarks that Buffett made on shorting in, I think it was the 1998 annual meeting. Very interesting stuff. He actually went short something when he was, I think he was still at Columbia in like 1950 or 51, and the thing exploded on the upside, and he came within a hair of having to declare personal bankruptcy. Now, Warren Buffett's career could have been very, very different if he'd had to declare personal bankruptcy in 1951 or whatever. I may be overstating it a bit, but it scared the hell out of him, let's put it that way. And I think that you know, is one thing about shorting. You know, your return is a maximum of 100%, and your downside is potentially unlimited. The long side is exactly the opposite. He also made the point about how a lot of the people that you really want to short are crooks. And the thing about crooks is they're really, really good at manipulating the market and bootstrapping value into their companies. You know, you short the thing at $40, and the next thing you know, the guy does a massive stock issue because all his broker friends go out and pound the thing around to various chumps around the street. All of a sudden, you've got a value investment rather than a short. So it's just not something we do. We've considered having a fund that would do paired trades, but there's a couple of issues about it. One is that you could potentially end up short something that you're long someplace else, and I can't get my mind around that. And you know, I'm talking about, you know, long Power Corp, short Power Financial type thing. You know, if we were long Power Financial in our funds, then how would we explain that? The other aspect is I think it's too short-term oriented. I think what we want is people concentrating on trying to find companies that we can buy and hang on to for a long, long time, rather than companies that are possibly exposed to declines in the short term. But, you know, lots of people are very successful at it. You know, it's, several of my best friends are hedge fund managers, and they made their money on the short side through the 80s and 90s when you really had to have a sharp pencil to make your money on the short side. Some of the very best people in the business are shorts. But we've also got this new phenomenon, which is really corrosive shorts, like people that are, I think, engaging in commercial fraud in order to get to engineer stock price declines. I don't have a lot of time for that stuff. There's a lot of that going on. Yes, sir.
How do you see the U.S. dollar and U.S. manufacturing available?
Well, I should preface my remarks by saying that if my family had relied on my abilities as a currency forecaster, we'd be a much poorer group today. You know, I just think that the U.S. dollar, the U.S. consumer, this is all part of the consensus. You know, everybody's scared about it. U.S. large caps as well, that, you know, a dead asset class. I think it's a highly prospective place to be. I think the U.S. Fiscal and monetary issues are a lot less scary than most people think they are, and I suspect the U.S. dollar will not collapse or decline substantially. That's a reasonably controversial view, I would say, particularly since the Canadian dollar has been so damn strong. But in the U.S. manufacturing sector, I mean, there's not much of a left, I guess. What is it now, 13% of GDP or something? It isn't an area where we've tended to have a lot invested. That's been a misfortune the last little while. You know, we had Caterpillar and Johnson Controls at one time in our portfolio, and I really wish I'd held them because they're good companies and they've done extremely well. But I don't think I'd buy them here. And we talked about the auto sector. That is clearly a troubled area and a huge exposure for U.S. manufacturing. Pharmaceuticals, healthcare, a lot of consumer staples stuff is good. There's some selected financial services that are good, and media. Media has just been pounded down there. I mean, I concede that there are issues around various kinds of media, but you're able to get them at great prices these days.
Are you referring to the American equity fund?
That's correct, yeah.
Yeah, I just noticed that just on the year-to-date returns, like there's a lot more volatility in
Yeah.
Like only like 35%, 95%, especially since 2002. It's like some of the other funds have been a little bit more stable.
Yeah.
I'm just wondering, is your strategy fundamentally different from some of the other funds?
It's a more concentrated fund. You know, of the comparables there, let me see.
Like Canadian equity funds and focused Canadian equity funds and stuff like that.
Focus Canadian equity would be similar as far as the number of stocks is concerned. Focus Japan would be as well. So I would say it tends to draw from a narrower group of industries too. You know, most of those industries I just mentioned are industries that we would almost always have representation in. And as you probably know, U.S. pharma has been just ugly for several years now. That fund also owns a small position in the smaller companies fund, which may account for some of that. But with all its volatility, it still has a pretty decent sharpened information ratio. So the long-term returns are okay. I don't know exactly how to answer you because, you know, frankly, we don't particularly measure it or care about it. And I don't think clients do either. Yep.
Those numbers are after effect of exchange rate, isn't it?
Yeah, these are all Canadian dollar returns, but they're gross of fees.
How do you go about managing the exchange rate risk, or is there any inputs to the decision regarding different portfolios?
We don't. We accept currency risk as part of the risk of doing business in other venues. When we launched the Japan fund back in 1998, we went to Tokyo and we met with a Canadian guy who was CSFB's strategist, and he brought out his presentation. It was called Apocalypse Now. And the yen, which was at that time at I think 120, was going to go to 190, and the market was going to collapse completely. And you know, I looked into hedging, but in my experience, bottom-up people shouldn't do top-down things. Perhaps a small illustration might give you an idea of what I mean by that. When I joined Burgundy, the previous manager that we'd had, who was an absolutely, you know, stone cold value guy, like really ice water in his veins. He had decided for some reason that this was the end of 1994 that the U.S. market was going to crash. So he put a humongous amount of our money into my client's money into S&P puts. December 1995 puts at 480 on the S&P. And by the time I came on board, those things were practically worthless. And it cost the portfolio something like 5 to 7%. He was a good guy, you know. He could have just stuck to his bottom-up discipline, and you know. But he got scared, you know. He got influenced by, I don't know, if it was some book he read or if he was, you know, looking at technical analysis, or I don't know what it was. But, you know, bottom-up people shouldn't do top-down things. That's my thinking. So the way I try and manage Burgundy is where we have top-down issues like asset allocation and so on, bond duration or whatever, we make a long-running decision rule that makes us do the right thing. Like for a lot of the funds you'll see here, they have a benchmark, and I'll rebalance to that benchmark. So if it's 50% U.S. equities and 25% Canadian equities and 25% non-Canadian equities or non-North American equities, I'll just rebalance to that. That means I'm selling the outperforming asset and I'm buying the underperforming asset on an ongoing basis. And where I come from, that's what you're supposed to be doing. So I just try and take it off the table. You can't completely, but I try to take it off the table.
How important is discipline?
Well, it's really important. I guess The problem is to determine when you're being disciplined and when you're being stubborn, when you're being inflexible. It's just like, it's sometimes hard to determine the difference between being contrarian and being suicidal, right? I mean, the market will tell you that ultimately. But I think, one of the things we have is sort of a common vocabulary in our shop, sort of a common understanding of what it is we look for. And we can all recognize it when we see it. We maybe can't always describe it, but we can all recognize it when we see it. And to me, that's our discipline. That's the sort of...
The checklist where you say, got to like a pilot before it takes off, I guess.
Yeah, I mean, particularly for the analysts when they come with us, they're kind of given a checklist to go through, and they're allowed to sort of gradually depart from that over time as they get more experienced. I think it's, for the most senior people, it's just sort of they feel it in their guts. So it's, like I said, it's a very very qualitative, experience-based kind of situation at Burgundy. Yep.
I don't see the income trust product that you guys are talking.
We actually had, we were very critical of the first wave of income trusts back in 1996, 97. We wrote, there's something called The View from Burgundy, which is on our website, and there's a couple of those, one called Heartbreak Hotels and stuff like that, because they were, the corporate governance was unbelievably bad. I mean, it was essentially, CP Hotels Income Trust, Legacy Hotels Income Trust, was just a joke. So we kind of showed how they essentially set it up so that the hotel management company was a really good business. The hotels actually weren't very good at all. But it was a great way for Bill Fatt and his guys to make tons of dough no matter what they did. They got a fee when they sold a hotel. They got a fee when they bought a hotel. They got a fee. They charged fees not based on any market value, but on some undepreciated book value number. It was a joke. So we came down pretty hard on those. Then we had, during the 1998 spread blowout, those things just got axed. I mean, it was unbelievable, the stuff that was happening. And there were 20% yields everywhere you looked. So we launched a product. It was called the Premium Yield Fund. And what we found, unfortunately, was that they were so administratively intensive, and our back office was already so stretched with the growth we were getting from having had a couple of pretty good years, we had to actually close the product down. One of our managers, Alan McDonald, is still sort of wearing a black armband about that. He thinks if that product had been open over the last few years, we probably could have had, I don't know, $500 million in it or something like that. But in practice, we have been very sparing in our investments in income trusts. I can think of, we've had quite a few of them in the Canadian Small Cap Fund. In the Focus Fund, we have one, Yellow Pages. So we've been, we had Athabasca Oil Sands once upon a time. I wish we'd kept it, although we probably would have sold it by now anyway. See my early remarks about being early. And I can think of maybe, 2 or 3 large ones, and Timber West was another one we had. But we've been pretty cagey about them, I think, by and large, especially the business trusts. You go through the prospectuses for these things, and just about all of them say, well, our depreciation's overstated. So we're able to, pay out part of our depreciation, distribute some of that money. I don't buy it. Businesses require reinvestment, and a lot of these things, when they come into their reinvestment periods, they're going to have to reduce or pass their distributions. So I think you've got to be very careful in that sector, and we have been. And lots of other people have built huge businesses while we've been careful.
Now, before we finish, I just want to ask you 2 last questions, I guess. What's the biggest mistake that these people make as buying investors?
Well, I would say we all have a value trap in our future. I'm still hoping mine are in my past, but you're going to find a stock that looks irresistibly cheap and it's plainly obvious that this is going to be one of the best things in your life, and it's going to age you day by day as you wait for something to happen, whether it's because of a bad management or just a lousy business or assets that weren't as good as you thought they were or a market that's adverse. But those are, there aren't very many mistakes in investing that aren't also good lessons. And the ones that aren't good lessons, you know, things like Marsh Mac, who knew? It was a meteorite, you know. Who knew the Elliott Spitzer would decide to, you know, just put the sniper rifle on the chairman and CEO's head and pull the trigger. So I think one of the very few witty things ever said by a consultant was he said that the motto of portfolio managers should be to err is human, to be paid for it divine. And I think the fact of the matter is you learn. That's how you learn. The market teaches you. The market will keep you humble. I don't understand how people can have big egos in our business, because the market, if you're riding high, the market is about to take a giant dump on you, and that is just life. And you're going to learn about your mistakes. It's like Buffett said, you know, that you find out who's swimming naked when the tide goes out, and that's not a pleasant process, but it awaits us all. And you just have to be able to be sufficiently disciplined and self-confident and rational to sit back and analyze it and say, here's what went wrong, here's what I can do so I'm not going to lose my clients' money the next time this happens. So mistakes, I hope the biggest mistake that they make is that. Biggest mistake anybody can make is anything to do with ethics. You know, we've seen quite a few people for trivial things destroy their careers, and those are the things that are really tear you apart. It's a great business if you get into it. For God's sake, you know, make sure that you obey that idea about, you know, don't do anything that you wouldn't want to see on the front page of your hometown newspaper, because that's the bottom line. You know, you look at things like, you know, Frank Mersch and Veronica Hirsch back in the 90s, you know, for these trivial deals, registered themselves in Vancouver and, you know, got some shares issued to them that should have been only issued to BC residents and stuff. I mean, these are people who are making good money. I mean, they've got great careers. Why do they need that kind of stuff? So those are the really bad mistakes. Nothing you do in the market is going to be an irreversible mistake.
So if I ask you, I guess, and this may be related to this, for the last 25 years of your investment experience in life, what would be the most valuable lesson that you got?
I think to some extent, you get the luck you deserve. You know, I think not taking anything for granted would be an important thing. You know, constantly reviewing, constantly going back to first principles. You know, use Occam's razor. I think that's the important thing, keeping first principles. Okay. Thank you.